Hey everyone, this is Finding Value. What I want to touch on is real estate and potentially what we have for a setup going forward. And it mainly deals with buying assets and paying back on a fixed rate 30-year mortgage with an inflation rate around 5%. So let's jump right into it. I think this is going to be pretty valuable to understand. So what I'm showing here is if we were to purchase a house, and let's say the house is 300 something thousand and the loan value is 300,000. So the loan is 300,000. We've got a 30-year loan. It's a fixed rate at 2.75%, and I have an inflation rate of 5%. And that's kind of the average what it was looking back 30 years, the real inflation rate. We have a monthly payment of $1,225. Yearly, it's $14,700. So the total payment in dollar terms, because it's a fixed rate, is $441,000. And you say, oh man, that's quite a bit larger than the 300,000. But if you discount your payments back over the 30-year period, so 14,700 discounted at 5% is 14,000. Then you add 14,700 plus 14,000, you discount it back 5% as you go back to get today's dollars. The loan value of today of a $300,000 loan at a 5% inflation rate is $225,975. You could say, well, how could the net present value be lower than the 300,000 original amount? Well, if you have an inflation rate that's greater than your fixed rate mortgage, you're actually benefiting more by not paying it off quicker. So the Dave Ramsey types and the ones that did the analysis of millionaires in the 1980s and 1990s, just like my parents, they had much greater fixed rate loans. They were in the teens and high single digits for some of them, but if they refinanced and whatnot. So of course they would benefit paying this off as quickly as possible if your inflation rate is lower than your fixed rate loan. Today, it's opposite. We've got a fixed rate loan that's lower than the rate of inflation, the real rate of inflation. So we would actually benefit by not paying it off sooner. Now, somebody would say, well, $1,225, that's a lot. I mean, that's a lot of money per month. Now, let's look backwards. Let's say we were gonna finish paying off a house this year, and we purchased a house in 1990. The house in 1990, the median home price was $79,100. We put 20% down, and our loan would be $63,280. In terms of a monthly payment, that's $258 per month. So it would be equivalent of paying a $258 mortgage, $258 a month mortgage now. It's $258 a month, tough to pay off. No, that everybody look at that and say that's a joke. I mean, that's like what people pay for gas a month in some vehicles. Now, what does a $1,225 look like? What is it at a 5% rate? Well, it's $283 a month in $1990 at a 5% inflation rate. So it's pretty close. 258 versus 283. So we need to look and we need to discount using the real rate of inflation. And we need to understand where we are with the government and how much unfunded pensions, how many problems they have, and how much money they're going to print to cover those unfunded liabilities, to cover any of their spending that they're going to have, to cover all of these QE sessions, to cover all of this stuff that they have going on, these bailouts. It's ridiculous. So one way that you can grow your wealth in a scenario that we're in is to get some real estate, to get a loan, and to have an asset with a fixed rate loan where they're just going to have inflation pay it all away. So I think that's a good plan for somebody or anybody who wants to buy real estate and have them inflated away. And I think what you're going to see is you're going to see a lot of the money is going to exit bonds and stocks, and they're going to start to run towards real estate. So you're going to see a lot of investors start going into real estate because it's the best inflation hedge out there. Precious metals is a distant second because real estate is a leveraged bet. And then I'm showing you what that bet looks like and how not paying it off quickly is actually going to be more beneficial because your net present value of the loan goes down even more as you don't pay it off. If you pay it off quicker, your net present value on the loan is going to go higher. The bank's going to get more money, if that makes sense. This is Finding Value. Appreciate your time. Please click subscribe and leave comments. Thank you.